Gold is not finished going up. Gold could be 3,500 next week. Maybe it'll be 4,000, right? A massive increase in earnings. And their earnings in 2025 are going to be even greater than they were.
Peter Schiff has been right before, and he's warning again. Are you listening? The markets are moving, but are they telling the truth? Stocks are up, but the cracks are showing. Investors are chasing bubbles while smart money is making its move. Inflation? Still here. Rate cuts? Coming. And gold? It's setting up for its biggest move yet. Stay tuned, because in this video, we're breaking down the real story behind gold stocks, the market's hidden signals, and how you can stay ahead of the game. Watch now before it's too late.
But before I do, I want to get into the gold stock reaction to the news. So gold stocks got hammered even more than the overall stock market when the price of gold was not down very much. Now it's down about $6 or $7 today, but it's still, tonight, I'm in the evening, but it's still $29.30. The record high is $29.42, $29.43. So we're almost at record highs in the price of gold. So why did these gold stocks get clobbered? Well, I think it was more of a buy the rumor, sell the fact on the phenomenal earnings that gold stocks were reporting on Thursday and Friday. And they bought the rumor, sold the fact. Except nobody really bought the rumor. They just sold the fact. Nobody was buying gold stocks because of all these great earnings, at least not that many people. But they sure, programmed the computers to dump them as soon as the earnings came out, especially if the earnings missed. So take a company like IM Gold, which I own IM Gold. We own that in our funds. That stock was down 9.4% yesterday. That's a big drop for IM Gold, right? And they missed their earnings, but their earnings were up 717% from the prior year. That is an enormous increase in earnings. Revenue was $1.63 billion. That was a 65% increase over the revenue from a prior year. So a massive increase in earnings. And their earnings in 2025 are going to be even greater than they were because a lot of the gain in the price of gold happened at the tail end of last year, and we've had a big move up already in the first couple of months of this year, right? So earnings are going to be up, but the stock got killed, but it's trading at 10 times earnings. If you're only at 10 times earnings and you just grew your earnings by 717%, why would your stock go down because you didn't grow your earnings by 750% or whatever it was the analysts had expected? It's almost like they deliberately have a high expectation so the stock can't meet it, so it gets clobbered, even though the earnings growth is phenomenal. Now, Newmont Mining, though, right? Newmont Mining reported, I think, blowout earnings. The stock was down almost 6%, on Friday. And it's these type of stocks, right, that are really driving the narrative. But so Newmont was supposed to earn $1.09 for the quarter. They earned $1.40. So 31-cent beat. That's a big beat. Also, their earnings for the quarter, the rise from the prior quarter was 285% increase in profits. And revenue is $5.6 billion. But almost a tripling in quarterly profits. And the estimates, they beat their estimates by a full 9 percentage points. But the stock went down. And the bad news, right, what really got people to sell the stock was that they forecast their all-in production costs would be higher in 2025 than they thought. I think it was around $140 an ounce extra. Now, why are costs going up? Maybe they're mining some lower grades. Inflation is driving up costs. But gold is already up by about $300 an ounce this year. So gold is already up by more than double what they said their costs are going to go up. So that's still bullish. Yet analysts ignored the beat, right, and just focused on this negative comment that costs are going up, but completely ignoring that gold has already gone up more and will probably go up a lot more, right? Gold is not finished going up. Gold could be 3,500 by the end of the year. Maybe it'll be 4,000, right? But nobody is factoring any of those possibilities into prices. So, they just dump these stocks. Look, I think it's a great buy. I think these stocks are going to bounce back pretty strong next week. I think this is a gift, the fact that they were down on Friday. So you should buy them on Monday. As I've been saying, I think buying gold in the ground is cheaper than buying it above ground right now. It's already starting off good, right? Gold stocks are up 15, 16% on the year. They were up about 20% until Friday. So I think they're already off to a good start. But I think this is slow compared to what I believe is going to happen later in the year as this stagflation scenario really unfolds. And people appreciate just how bullish this is for gold and how bearish it is for the dollar. The gold stocks got clobbered very hard, unnecessarily so, which is, again, typical the case for the gold stocks. The GDX was down about 3.4% on the day and about a similar amount on the week. And the GDXJ was down 4% on the day, which again was about the weekly decline. But gold was barely down, maybe $2 or $3 on Friday, and it was up about 1/3% on the week. So again, gold went up and gold stocks went down. Now, gold stocks are still up about 15% on the year, so they're still beating gold, which is up about 10.5% on the year. But they should be up a lot more when gold has been this strong. And I'm going to get to the gold stocks a little bit later as far as, why they went down. But I want to talk more about why the overall market went down. What was the news that drove the stock market down on Friday? And I think it's more confirmation of stagflation, which is exactly what I have been predicting all along. And of course, stagflation is the one economic condition for which the Fed has no contingency plan. When Powell was asked what his plan was for stagflation, he knocked wood. He banged on the podium and he said, well, we're just going to hope we don't have it, right? Well, hope is not a plan, right? But the reason the Fed doesn't have a plan is because there's nothing in their toolbox that will work, right? The Fed doesn't have a lot of tools, right? It can cut interest rates, it can raise interest rates, it can expand the money supply, or it can contract it. That's basically it. Although it never really contracts it much, but it can do QE, it can do QT, whatever, but that doesn't have a lot. But when the economy is weak, that's when it cuts rates and supposedly prints money. When the economy is strong, it raises rates. Well, what do you do if the economy is weak and inflation is strong at the same time? The Fed's got nothing. That's why they just hope it doesn't happen. And that's also why the stress tests that the Federal Reserve develops for the banks does not include a scenario of stagflation. Because I think the Fed knows that none of the banks could pass a stress test if they had a test for stagflation, which would be a weak economy where inflation and interest rates go up. Because the worst case scenario that the Fed has asked the banks to stress test is a weak economy where interest rates plunge and inflation goes way down, right? Which is not that bad. What is bad is a weak economy where interest rates and inflation go way up. But the Fed did not ask any bank to run the numbers on that scenario because I think they know that all the banks would fail. But that's exactly where we are headed. And that is what the economic data that came out on Friday confirms. So let me take a look at some of that data. First, we got the consumer sentiment numbers for February. And last month, the January number was 67.8. And the expectation was for a slight improvement to 68. Instead, we went sharply in the other direction, all the way down to 64.7. That is a plunge in consumer confidence. In fact, the range of estimates for this number was a high of 70.1 and a low of 67.8. We came in way below. In fact, nobody thought consumer confidence would go down because 67.8 matched the number we got last month. So everybody thought that consumers would be more confident. They just disagreed on how much more confident. But instead, confidence collapsed. And the main reason was rising inflation expectations. So for the year ahead, that 2025, consumers are expecting 4.3% inflation. That's unchanged from what they were expecting in January.
The signs are clear. Gold is making its move and the markets won't wait for anyone. If you found this insight valuable, smash that like button to help more people see the truth. Subscribe and hit the bell icon so you never miss Peter Schiff's latest market insights. And let me know in the comments, where do you see gold heading next? Thanks for watching, and I'll see you in the next one.